So as you can see, we have the three candles here, the three momentum candles here, which indicates an uptrend here. And then another three bearish candles here indicating a downtrend right there. So our fair value gap area is this area between the first candle's high and the third candle's low. This area between is called a fair value gap because these 2 weeks do not meet, meaning there was no fair price at this area here. The same thing that happens in a downtrend. We will see that the wick of the first candle and the third candle, they do not meet. As a result, this is what is known as a fair value gap. Let's go dive deep in these three candle theory so that you understand them, because their value gaps are different and they have different characteristics which you have to understand. So firstly, the three candle theory states that the first candle can be a momentum candle or a ranging candle. Okay, the first candle can be a momentum candle or a ranging candle. And then but the second candle must always be a momentum candle. The second candle must always be a momentum candle. And then the third candle can be a ranging candle or momentum or anything. It can do whatever it wants, just like the first candle. So let's take a look at these examples that I've outlined right here. Let's just zoom. So as you can see, we have 4 examples right here. The first example here, we have 3 momentum candles. 3 momentum candles. The first one and the third, they do not meet. And then this area here is regarded as a fair value gap area. Okay, so as you can see, we have the first candle, second candle momentum, third candle momentum. So this is a first scenario on how a fair value gap is formed. And then the second is where you have 2 momentum candles plus a consolidation candle, which is the third candle. So a third candle here is a consolidation and does not meet the first candle's high here. So this is a valid fair value gap. And the same thing here on the third example here, we have 1, 2, 3 candles. The first one is a consolidation or a ranging candle, and then the second one is a momentum candle. Then the third one is also a momentum candle, but the wicks do not meet. As a result, it leaves a fair value gap area. The fourth example here is we have 2 consolidations, the first and the third candle, and then the second candle is a momentum candle, and it is valid because they do not meet. If we have a fair price at this area, then these wicks should have met here, but we do not have a fair price for the sellers right there. Only the buyers has got chance to get involved into this market. Let's dive deep first. Okay, so what do fair value gap indicate in the market? So firstly, they indicate that there is no fair price. And then secondly, they indicate that momentum has just entered in the market. Then the third thing, they indicate a fake move, or they can be used to fake out traders, okay, to get you on the long side of the market. For a no fair price, let's take a look how it may look like. So for example here, we have a fair value gap area here. So what this indicates is that the buyers were in control and were involved in the market, and then from this week's high to that week's low, the sellers had never had a chance to get involved in it. In short, there was no fair price for the sellers to get involved at this moment. As a result, this occurs and creates a fair value gap area. So this is an indication that the sellers had no chance at this moment. And then the vice versa here is the downtrend where the buyer has no chance to get involved and in this market. But here's a good example. If you see this week's low and that week's high, from this week, when price came down to here, it pushed price all the way up there, meaning the buyers got involved at this moment here. The same thing here, buyers got involved at this moment here, up to there. But from this moment, from this moment to that moment, they never had a chance to get involved. Okay, as a result, there was no fair price out there. So let's take a look at the momentum itself. Okay, so as you can see there, the three candles are momentum candle. Whenever you see this, mostly when you're coming out from a ranging market or a consolidation market, you will see these three candles. All right, three candles. There could be 4, 5, 6, or 7 candles with momentum like that, indicating that the buyers are now in control. Okay, as we have broken out from the range. And the opposite is the same. When the sellers are in control, they will break out from the range and then to continue the trend. And whenever you see momentum candles, they indicate liquidity in the market. They indicating that the buyers or the sellers are now getting involved. So for a fake move, for fake momentum, let's take a look at a fake momentum. So for a fake momentum, it will be something. For momentum, it will be something like this, where when you see the three momentum candles leaving a fair value gap area, this can also be a trap. But we'll be diving deep to understand why this happens and how you can avoid it. So in this case, when we are bullish on this day and then you see this push down, creating another fair value gap, then you might want to consider to change your direction of the market. Remember, the trend is your friend. So whenever you see this, after this, then you might want to consider to sell, to look for sales instead of the buys. Because mostly it can be a manipulation here or a Judas swing, as ICT mentions in his theory. Okay. So types of fair value gap. Now, you have to pay attention now because this we will remove the doubt by understanding each and every type of it. Okay. So firstly, we have what we call a standard fair value gap, a normal fair value gap. Secondly, we have a breakaway gap. Breakaway gap. Thirdly, we have the overlapping gap. Okay. The fourth one is a mitigated fair value gap. So for a standard fair value gap, it looks something like this. A standard fair value gap is a gap with 3 momentum candle. Remember, the first candle can do anything, the second candle can do anything. But when defining a standard fair value gap, we are considering the behavior or the characteristics of the third candle. So when defining a fair value gap, we are considering the third candle there, the characteristics of a third candle. So for example here, this candle here does not, I repeat, this candle does not cross above the high of this candle. Okay, it does not cross above the high of this candle. This candle can wick above but does not cross above, then that one is what we call a standard fair value gap. So what does this really mean in the market when you see a standard fair value gap forming? Then this means that anytime we might come back to this area, we might come back immediately to this area to mitigate or to rebalance. Because remember, we have an imbalance area here where there was no fair price here. Meaning, where there was no fair price here. And then when you see a standard fair value gap being created, it simply means immediately there will be a rebalance or a fair price for both the buyers and the sellers to get involved in this market. Okay, so this is what it means, a standard or a normal fair value gap. Let's go ahead to a breakaway gap. So a breakaway gap, it will look something like this. It looks something. A breakaway gap looks like this. So the first candle, I don't want you to consider the first candle. I want you to consider the third candle. Remember the standard fair value gap, the candle crossed below there. But for a breakaway gap, it crosses above. That's why it is called a breakaway gap. Why? Because it breaks here and crosses away from the high, okay, from the high of the second candle there. So what does this mean? This means we are not likely coming back immediately here, okay. So this is the difference that you can see in these fair value gaps. When you have a breakaway gap, we are most likely not coming back immediately, but instead we'll be going higher and higher until we mitigate something, or we sweep an old high there, okay, and or we sweep an old high or mitigate something there, and then that's when we can consider to come back here to offer fair price and then continue higher. So this is how a breakaway gap behaves. Those are the characteristics of a breakaway gap. So whenever you see something like this, you don't have to worry, because most of the time when you see the breakaway gaps, there may be 1, 2, 3, or 4 of them on top there, and then you on top there, and then you'll be worrying, which one can I use? Anyway, we'll get to that in details, but for now I want you to know that a breakaway gap must always go up and mitigate something, okay. So continue watching so that you know which fair value gap you'll be using in each and every scenario. So far we've understood that a standard one is the one that does not cross above, meaning we are going to come back immediately into the gap and then cross above. And remember, coming back into the gap, we do not need to retrace deep, but even a small sting into it, that is it. We can continue higher. That's the way it is. So let's continue and look at a overlapping gap. Overlapping gap. So for overlapping gap is simply a gap that overlaps with another PD array. So in this case, we have this overlapping gap with a breaker block here. Okay, this fair value gap overlaps with a breaker block here. It could be a block, it could be an order block that it overlaps with, but in this case, we have a breaker block overlapping with a fair value gap. So now, to answer that question, which fair value gap should I be using? So when you see a breakaway gap, and then it forms more and more gaps on top there, then the gap that you want to consider is the one that overlaps. Okay, is the one that overlaps. This theory also applies with a breaker block. The breaker block that overlaps with a fair value gap, they are high probability. So a high probability fair value gap overlaps with a PD array. Okay, so if you have maybe 5 or 4 breakaway candles, breakaway gaps there, do not consider them. Wait until price reaches at the overlapping gap, and that will be the high probability setup to go long in this case. Okay, so let's continue with the mitigated fair value gap. So for a mitigated fair value gap, this one is simply a mitigated one, meaning it has been traded back into already. Okay, this is the definition of it. A gap that has been traded into already, it's called a mitigated fair value gap. Mitigated fair value gap. So in some scenario, you will see that like price may come into this area and just have a small sting into it and then pushes up. That one is a mitigated fair value gap. Whenever you see price coming back to this area, at this moment, you will not consider this as a draw on liquidity, but instead you consider the low or the high in that fair value gap to continue the trend or to be your target. Because here, if you are retracing deeper and deeper, then it simply means we are targeting the sell side liquidity here, or vice versa. We might be targeting a buy side liquidity in a downtrend before we could continue the trend. Okay, so it's worthy considering like that whenever we mitigate a fair value gap, it's no longer valid for a draw on liquidity, but the low or the high that is inside the fair value gap. Okay, so How to use fair value gaps. Firstly, we use them for narrative. Of course, that is looking for a PD array where price is most likely to continue from, or where you are most likely to continue the trend from. That's the narrative. Okay, that's a narrative, and that always happens in your higher time frame. Okay, in your higher time frame, not in your entry time frame or your analysis time frame, but in your higher time frame where you will be looking for the narrative. So second time we use them as the context. Context, we are simply looking at fair value gap either in the discount or in the premium. Okay, in the discount or in the premium. For example, if we are already in the premium and we are expecting a pullback, then in that premium area we'll be looking for a PD array to push price lower into the discount. And then in the discount, we'll be looking for a fair value gap to push price higher. Okay, so that will be our context. Are we in the premium or in the discount? Where are we looking for our PD array? So the last but not the least, we use fair value gap for our entry points. Okay, yes, and our entry points. So for example here, we have this gap here, and then we would be looking for our entry pattern right there in the fair value gap to continue the trend. As you can see on the real charts here, we have the series of higher high, higher lows right there. Inside there are fair value gap. We have one fair value gap here, another fair value gap there on top. So when you look at this fair value gap, this is the one which is called, this one here is called a breakaway gap. Why is it a breakaway gap? Because the third candle here, which is this one, has crossed above the second candle. So it's a 3-candle pattern, remember? The first one, second one, and the third one. So this one is our breakaway gap. And then we do have another one here. Okay? We do have another one over here. We do have another one here. What is this fair value gap? This fair value gap is also a breakaway gap. If you notice there, one thing that happened in the market is that after creating these highs here, instead of continuing higher from this high or from this fair value gap or this gap here, which is overlapping with an order block right there, we started ranging. So whenever you see a ranging market like that on a fair value inside the fair value gap or on an order block or anything, just know that it's a low probability. Otherwise, it's supposed to come sting into it and then continue higher. But in this case, we saw that price started ranging. It also tapped into this bearish fair value gap. Mind you, this is a bullish fair value gap, meaning bullish prices. Okay, then this is a bearish prices, meaning bearish prices. So at this point, we see that this candle here sting into this high here, and then it failed to continue lower. And again, it came back to take out this high. This is the reason why I said, once we sting into the fair value gap, or once we tap into the fair value gap, the next thing, we are not going to consider it as a draw on liquidity. Sometimes price can come sharply like it did here, just to rebalance, okay, just to balance it or take out the highs and the sell stop above it, and then eventually you will see price continuing lower like that, just like we have learned in the previous lesson. So what does this show? This shows that now we are in a downtrend. After this big push here, this is a breakaway gap, another breakaway gap. And then we had another breakaway gap here, another breakaway gap here. So once you see this series of breakaway gaps here, do not get confused. Look for one of the gaps that is overlapping with an order block, breaker block, or mitigation block. In this case, we have this one here overlapping with this order block here. Okay, overlapping with this order block, which is also a breaker block. Okay, a breaker block, because we broke this block here. So this fair value gap on top, the first one, was overlapping here. That's why it became a high probability fair value gap. All these down here, they will not be considered to trade back into and then continue lower. So this is the science that repeats itself over and over. And as you can see, we had this big push here. So remember what I told you? You must see a big push thinking, okay, I think now the trend is about to change again because we have this change of character. No, it's not going to change. Why? Because we have an objective to balance price through the overlapping gap, which is over here. The overlapping gap. This is why you see this big push here. So you must know and understand that every fair value gap indicates a momentum to somewhere for rebalancing or for taking liquidity, for two things only. When you see fair value gap, it's either for rebalancing or for taking liquidity, just like that. That's the purpose. So our main thing here for us is to make sure that we know where price is heading to and why it's leaving fair value gap. Because in the lower time frame, this big bullish move here, there are fair value gap that were created which you can take a trade. As long as you know where the price is going, it is fine to enter the trade here and then exit right there on this candle here, right there on the low of that overlapping gap over there, and then you continue lower again. And as you can see here, I think we have a small sting here, a small sting into this gap that was created here. This is a big sign there that we are continuing lower. And remember what I told you, as long as we have not crossed below that low, then we are more likely to come back and sting into it. And this is what happened. We sting into it, came back, and then continued lower. And then we created another gap here, which is a normal gap, which is supposed to be traded back into. You see, the same thing happened here. It is repeating itself, okay? After a cross below the wick there, you see, the cross below the wick, you will realize that there will be consolidation candles. It could be 6 or 7 candles right there. But one of the candles will sting back into it and then push prices lower. And then at this moment, you will see that we created another fair value gap here. Okay. And then we see that at this moment, we did cross, but at this moment, we did cross up below that, but we had a push into it. And then this type of push where we even swept the lows there. At this moment, if you go advanced, you realize that this was a sweep. And once we have a sweep, then we are expecting a deep retracement into the fair value gap. Whenever we have a sweep, okay, that's a bonus for you. Whenever we have a sweep, then we expect a deep retracement into the order block, like the one we are seeing right here. This was a deep retracement. At this moment, we are not looking at this as our draw on liquidity, but we are looking at it as a sweep. If you are going to continue lower from, we are sweeping these highs here because there are people who entered here to sell, so they may be trading their stop loss, or their stop loss might be somewhere there. So they are taken out, especially at this high. The stop loss were there, so they were taken out, most of them here, meaning inducing more liquidity in the market. And then we continued lower, creating new fair value gap. But notice one thing here. This fair value gap is a not fair value gap, but it was not traded back to. It doesn't have to, because the market can do whatever it wants. All we want to see is the cruise in the market. It's not a mass thing that will happen, but it's a cruise. It's an idea of that keeps every trader on the positive side of the market. Okay, so as we can see, price continued lower. It created another fair value gap here, but it started consolidating, and then a big push. It did not respect this the fair value gap. It disrespected it, creating a new fair value gap, which is a breakaway gap. Okay, a breakaway gap. So what did it do here? It finally came into this gap here. If you notice, it finally came back to this gap here. Okay, and then pushes price lower. And that one is more advanced, but it is similar to what happened here. We had a big push showing a fair value gap. Mostly, remember what I said, these breakaway gaps, mostly they have to mitigate something. Once they mitigate it, then that's when you see price moving lower. But for a normal fair value gap, immediately there will be a rebalance or just a small sting into the gap and then continue higher. Okay, so if you move on here, let's keep on moving. So here we have a change of character and a break of structure. And then here we can see that we created another gap here. We created another gap right there. Let me just pull it up to there. We created another gap here, and then this gap, just balance it here. This gap is what is a breakaway gap defined by this candle here. It's a breakaway gap defined by this candle. And then we see, of course, price pushing higher. And then we came back into it. We reacted into it, pushed higher, but eventually we came lower and lower and lower, deep. This is what we call a deep retracement into the gap there. Why the deep retracement? If you look closely here, right there, that high was swept. Okay. Whenever we see a sweep and then price tries to push lower, just know that we are going to have a deep retracement into the gap. Okay. Otherwise, this here would have been a continuation higher from this candle because we already retraced back into this gap. So at that moment we might be going higher, and we did that. If you target the previous candle's highs, this will be a good target. But at this moment, price reversed and continued lower, showing a deep retracement happening here. A deep retracement happening, or a deep pullback into the fair value gap. It even crossed below that gap, but immediately there was a sharp turn. Another push right there, creating a breakaway gap. Okay, and then it continues higher and higher. And here we see an order block being created. Then it pushes higher, creating a fair value gap. And then this fair value gap is an ideal fair value gap where it has to immediately come into it. And we see it happen on that candle there. Let's just zoom and see what happened. As you can see, this candle here came back and tapped into that order, into that fair value gap, and then continues higher. And then this push here, this is what we call a manipulation. Okay, this was the manipulation of the market. It should happen most of the time, but again it came back to the same fair value gap, crossing it and then pushes up. And then price has been doing that for some time until eventually, at this moment, if you see there are no fair value gap being created, so you might want to avoid the market at this moment until you see another fair value gap being created, that where you can continue higher from. So if you see here, there's just a small thing there in that fair value gap. You see, this is how a fair value gap works most of the time. It works like that. It's just a small thing into it, and then it pushes her price higher, continuing higher, creating new fair value gap, indicating we are still moving higher. Okay, and then as we can see, this is another normal fair value gap. Why? Because the third candle did not close above. We came back, sting into it another. This will be another trade targeting these highs here, and then boom, we are here. Okay, so right now the prices are right there. So I'm expecting price. So at this moment, you should be expecting price to come down and have that small thing, then continue higher. Why a small thing? It's simple because you see this area here, at this point here, this is where fair value has not been offered here. So we would want to see price to come down to that area, then push higher. Okay, yeah. Now, the next area where we need to offer fair value, it's at this area here. Okay, so for this week, today is the 14th of July, I'll be looking for longs just like there to push price higher. Yeah, you can also check out my analysis videos, yeah, which is more like a journaling videos where I analyze this market, and then I'll also be updating the results once I enter the trades and break down the strategy that I use. So that is it. Thank you for watching the video, and make sure to hit the like button and subscribe to the channel.